Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Joining us now for an extended conversation, synthesizing this economic moment with the markets. Michael Darda joins us this morning. Thrilled that he could be with us with Roth Capital. Michael, you go all hysterical on me here. You go back to President Hubert Hoover, 1930, 1932. We had a tariff hike, and they raised the marginal tax rate on the fancy people. Are we going to get a redux on that, or is that bluff and bluster from President Trump?
Great to be on with you both, Tom. It's a bit of a cautionary tale here, I think, for the Republican Party and the Trump administration, because obviously, even with this simmering down of trade tensions, the average effective tariff rate is going up meaningfully, the highest in 100 years. So you have to go back to Smoot-Hawley. Herbert Hoover, President Hoover, signed that in June of 1930. And then he also signed a gigantic tax increase, big rise in the top marginal tax rate through the Revenue Act of 1932. The Republicans would not see the presidency for 2 decades. And obviously, Smoot and Hawley got run out of office in 1933, never to be heard from again.
I look at this, it's a great walk through a history, folks, and the backdrop of this, of course, is a small mayorship election in Omaha, Nebraska, where the Democrats stunned. Nobody saw that coming. But Michael Darda, within the stew that you're looking at Roth Capital now, do you perceive that tariffs will be pulled back ever further from the ridiculous numbers down to 13 or 17%, whatever Ernie Tedeschi says, and it will bring them down even more so in the coming weeks and months?
Well, I think, Tom, that the China deal announced over the previous weekend is important, because those tariff rates were clearly in the prohibitive portion of the Laffer curve. You essentially had a trade embargo with those rates up at 145%. So no trade, no revenues, right? I mean, this is a good lesson in supply side economics. So getting those down to around 30, I think, is important. So it's still a big step up in tariff rates from where we were prior to the administration coming into office. But that backing down, I think, is important in the sense that if you're just doing a static forecast for how much this could disrupt growth this year, more of a slowdown, dislocation versus, potential contraction.
Paul Sweeney wants to jump in here. Torsten Slok publishing seconds ago. We bring that to you. And this goes right to the Darda conversation. Paul, you look at imports coming in, you think all the money goes to China. That's what the president thinks. Wrong. Torsten Slok saying 56% of the money stays in the U.S. Only 44 cents on the dollar goes to whomever in China. Just want to bring that up there.
Absolutely. So, Michael, can we, just as recently as 2 or 3 weeks ago, the recession discussion was certainly front and center for a lot of investors. Can we put that on the back burner a little bit here now that the president is walking back some of these tariff discussions?
I think so, Paul. I mean, we came into the year, obviously, with markets very hopeful that most of what President Trump was talking about on trade was going to be bluster. And, obviously, Liberation Day was a scorched earth set of proposals that markets did not expect. And then there was some feeling out for where the Trump put would be. So now I think we know, right? I mean, the administration is ultimately sensitive to what's happening in equity and credit markets. It may have been the bond market action in that first week of April that finally got the president to start to back off a bit. So I do think we can breathe somewhat of a sigh of relief here. If you look at the high yield debt market, those spreads shot up dramatically going into the first week of April. Basically a 50+% recession probability that's now receded down into the teens, if not lower. So that's quite helpful. Now, look, markets can be wrong, but I think in this case, the high yield market and jobless claims, watch those two really closely because they've been on the front edge of this soft landing and resilient economy.
So, Michael, in that context here, how does the Federal Reserve kind of look at the world here? How do you think they're going to behave this year?
Yeah, I think, related to your previous question, if, the tariffs alone really shouldn't put us into recession. I mean, where Tom and I started talking about the Smoot and Hawley and tariff or Hoover tax and tariff increases, really the Federal Reserve was responsible for torpedoing the business cycle in the 1930s, allowing a money supply contraction of 30% and nominal GDP to fall 50%, massive monetary contraction. So that's not going to happen this time, but there is some risk that the interaction between tariffs and monetary policy could create some problems. And really, it would be that the tariff disruption lowers the neutral rate. And if the Fed is tardy in lowering the policy rate, the business cycle soft landing could slip away. Now that these tariffs have been scaled back and moderated, that risk has declined, and the risk of the Fed potentially falling behind the curve has also declined. I'm pretty comfortable with where the Fed is right now. If you look at bond market inflation expectations, they've been low and stable, consistent with price stability, nominal wage growth, which is not going to be affected on a first order impact from the tariffs. Perfect, running right in line with price stability. So the Fed has the flexibility to move if need be. But with the tariff threat being scaled back, then there's going to be, less need for the Fed to move. I still think they will ultimately lower rates, but they're going to want to see a few months of the hard data, in my opinion, before they start to move. And that could put us into July, perhaps.
Michael, how about the consumer here? We're going to get some retail sales here later on this morning. Still looking for some decent growth kind of month to month here. How do you view the consumer these days?
Paul, it's just been amazing that consumers held in there this well. We know the low end is under pressure, but that's been the case for a while. The high end consumer, drives a bulk of the spending. And, with the stock market wobbling, that was a threat in February and March, but we've had this huge bounce back in risk markets. And at least so far, the labor market's been pretty steady. So I think that is going to be the key going forward. Watch those first-time jobless claims numbers. If they start to break out, that's going to be more of a potential issue. But we've held in there so far. So fingers crossed.
We'll see that in claims today at 8:30. Also retail sales here. Thank you to Commonwealth for support of all we do in economics. Michael Darda with us from Roth Capital. We welcome all of you in your commute across the nation. Good morning, 99.1 FM, Washington, 92.9 FM, Boston, up to Millinocket. We said the Celtics won last night.
They
did.
did.
You know that?
They won pretty decidedly, coming back to the Garden.
Bloomberg 11:30 with a game coming up here of basketball in the coming days. Michael Darda, Ken Rogoff with us yesterday, and he reframed. He didn't get on the disinflationary vector. He got on the stable rate or higher rate vector. And I'm sorry, I'm seeing it ever so slightly on the tape. I got a 495 30-year bond. Should we prepare for a higher nominal interest rate regime?
Well, I think, that is certainly a risk with fiscal policymakers not really taking the threats seriously. We've seem to have missed an opportunity here. I mean, Speaker Johnson has his hands full with just a 2-seat Republican majority, and he's essentially been held hostage by coastal Republicans that really want to boost that SALT tax exemption. So, Tom, it goes back to basic public finance theory that you want the broadest possible base with the lowest rates achievable. And if you move away from that, the code becomes less efficient. There's really been no stomach to do meaningful spending cuts, these entitlement reforms. So, we're not on a sustainable fiscal path.
Michael, let me cut to the chase. Let's do some Wisconsin whitewater academics here. Rogoff's with us yesterday. Stiglitz is known for the little g. The growth rate is really, really important. when looking at the debt and deficit. Are we finally at the place where in America, like maybe say in Italy, the growth rate doesn't keep up with our fiscal expansion?
Yeah, I mean, look, we are on a completely unsustainable fiscal course. I don't even really think there's a debate about that, but it's politically inconvenient to deal with it unless markets are forcing your hand. Are we at that point? I don't think we're at that point just yet, but nobody knows when that's going to come. And then if you're trying to straighten things out in a rush, in a haphazard way where you don't have time to think about what the proper policy adjustments are, that's not going to be an optimal outcome. I will say this on the 10-year yield, the yield has been picking up, and that is creating some hand wringing for sure. That looks a little more orderly to me, with risk assets rallying and the macro data being pretty stable on the hard data side in April so far, versus what we were seeing that first week of April, where the yields shot up 50 basis points over 5 sessions with risk assets cratering. I mean, that is not what you want to see. So I don't think that we're in the Liz Truss moment just yet.
Right.
But it certainly is a risk factor.
Get one more in here, Paul.
Hey, Michael, we're going to get some initial jobless claims today. A number kind of like 228,000, a number we've been pretty accustomed to. How do you think about this U.S. labor market? It seems pretty solid here.
It really is. I mean, we are in an unprecedented environment through the lens of financial history. And that is the unemployment rate moved up 0.8 of a percentage point from the lows of the cycle in the spring of 2023 to its recent level in the summer of 2024. That kind of a movement has never occurred, with the unemployment rate leveling off like it has over the last 10 months. Has never happened. So this is really the first time maybe in history that the Fed is succeeded in creating a soft landing, where all these recession rules of thumb have completely failed. I mean, every one going down the line. So maybe it's luck, maybe it's skill, maybe it's something else, but it's a unique business cycle, and this labor market is held in there beautifully. Now, hiring rates are weak. So if firing rates pick up, the unemployment rate will start rising again. And if that unfolds, then I do think the Fed will be ready to start easing in a significant way, but probably not until we have evidence of that. And so far, we do not.
Michael Darda with Roth Capital. Greatly appreciated.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Joining us, tanned and rested, Gene Seroka. He's executive director of everything we do in the the Port of Los Angeles is the official name.
Monster. I mean, it's acres.
It's ginormous. How many total employees?
At the Port of Los Angeles, a little more than 900. Every day on those docks, more than 100,000 people go to work.
100,000. Yeah, it's like ginormous. Forget about that. A few years ago, Roosevelt opened the Panama Canal. You were with American President lines in the deep port of Cincinnati on the Ohio River. What was your first day like in shipping on the Ohio River?
Tom, I came out of graduate school in New Orleans. The price of oil was $9 a barrel. Unemployment was going up. We just had a stock market crash in '87.
I recall that, unfortunately.
And I got offered an interview because my dad worked for American Airlines and I could fly up to Cincinnati for free.
There you go.
My first day on the job, I was getting coffee and dry cleaning for the sales reps, took a car to get it washed. That was my introduction to the shipping industry.
This is so important. Right now, every kid out there is trying to get a job. And what you just heard there is when they want coffee. You get it. It's all there is to it. What's changed now in the real world of the Port of Los Angeles? I mean, tariffs have been blown up. Is every ship in the nation going to crowd into your port?
I don't think so, but there's a lot of product on the ground in China that was manufactured before the 145% tariff was introduced. Every conversation I have in business is about what's next. Business community wants certainty. 90 days of this reprieve, Tom, is not a long runway in our business.
So what are you seeing when I just envisioned you in your office in the Port of Los Angeles, and you have this view of the Los Angeles harbor and the Pacific Ocean. You see all these ships coming over the horizon from China. Are the ships coming?
Not yet.
Not yet.
And I was on the phone last night with some friends in Singapore and Hong Kong, and bookings are picking up. Reservations for containers picking up. But here again, it's really quiet in Los Angeles today. By the end of this month, 17 of 80 scheduled ship arrivals will have been canceled, our volume down 25%. But even as this booking or reservation system has an uptick, it's going to take about 2 weeks for the liner shipping companies to reposition their vessels. And then once they load up the cargo that's on the ground, another 2 weeks to come to LA. Then we have to distribute throughout the country.
So we still have, even though I'm not even sure where we are right now, but I believe the tariffs have come down from their high levels vis-a-vis China, but they're still way higher than they were 5 months ago. So that has to impact just what Walmart's buying, what every retailers across the U.S. are buying, and what you're seeing at your port, right?
Right. The headlines from just a couple of minutes ago. Walmart's CFO says prices will likely rise towards the end of this month. Now, we have 125,000 companies that import through the Port of Los Angeles. They're not all the big guys. I'm most concerned about the small to medium-sized retailer. Your corner hardware store has to buy now at 30%, 40, 50%. And if they try to raise the price on the hammer or the tool kit that they're selling, they can't because they're competing with the big guys. This is a really tough position.
Can you explain how the tariffs work? So when a good comes off a ship in your port, how does a tariff get done?
Yeah, depending on the terms of sale and the nuances, et cetera, when an importing company wants to accept the goods, take them off the port property, they're given an invoice by Customs and Border Protection based on a harmonized code and what products are in that container. Before they can take possession of that box, they will have had to pay that tariff.
Okay. All right. So the importer pays the tariff. I guess that just happens, right? I mean, because it seems like it's so fluid. I'm not sure what the tariffs are if I'm an importer.
Right. And think about the customs agent who's got to assess what's in that container, the price of those goods, et cetera. And just to keep up with this is I'm in this business and it's hard to keep up with.
To your point in Cincinnati, what was your first day in Shanghai like? They send you abroad. You're the ugly American in Shanghai. You're looking for a cheap suit. What was it like your first day in Shanghai?
Tom, I was 34 years old and
You're on the Bund.
The Bund in Shanghai, beautiful, the lights up, the architecture, unbelievable. I had people like Frank Chen, William Chan, Philip Hsu, just holding my hand, guiding me through this. But what they said was, our hope is that you can learn a lot about what we do here and take that back to America. Okay. And for the guys and ladies on the ground here in the U.S., it was like, we have a contact over in Shanghai. Learn a little bit about how to move all this cargo, who's who, what we can do, what an opportunity.
Bring it forward now from the Bund down to Ho Chi Minh City, down to the booming Vietnam, that communist experiment right now. Identify for all of our listeners across this nation the China to Vietnam to U.S. trade moment.
Yeah, this is interesting, too, because I think many of us were surprised. Once that 145% tariff was put in, the American importer slammed on the brakes and said, I'm not buying, because I don't know if the information is going to change in 2 hours, 2 days, or 2 months. So what the liner shipping companies did was say, look, I've got to profile these vessels. I normally make a call in Shanghai or Xiamen and then come to LA. I'm going to make another call in Haiphong or Ho Chi Minh City. I'm going to try to get cargo from Lam Shabang and Sadaqib in Thailand, because if I don't profile this vessel, it's a cash loser, right? I've got to get 95% utilization on the ship, or else that voyage is cash flow negative. So you saw people just scrambling.
So right there, folks, is a window. It's no different than the truck from Dallas to Amarillo. You got to have a full truck or it doesn't work. Paul, get one more in here.
One more, Gene. So what are you seeing today? How do you kind of envision the next 1 month, 2 months, 3 months in terms of your port of Los Angeles?
I think you'll see a little bit of an uptick in cargo. Again, May is down precipitously with respect to volume. Folks are going to have to bring product in because we're at a critical point. Summer fashion, back to school, year-end holidays. We're going to have product on the shelf and online to buy. The question is going to be, what will be the consumer's willingness to pay. So the retailers are trying to do all this calculation right now, and I don't think anyone has the answers.
Do you think there'll be any empty shelves in the next several weeks, months?
I think you'll probably see lower levels of inventory and less selection, with prices ticking up just a little bit.
Yeah.
Yep.
We don't care. All we want to know is, can the Padres stay with the Dodgers?
Oh, that National League West is something
killer?
else. Oh, these guys, Manny Machado, these Padres,
They
I tell you
all
what.
want to live there. The bottom line is all the superstars want to live out with Gene Seroka.
And that rivalry is something else. Locally, this is the team to watch.
Have you seen the Port of Los Angeles tickets at Chevis Ravine?
Big, huge.
I mean, they're right by the Tom Lasorda box.
Yep, no
Gene,
question.
thank you. When are you coming back? You got to
here
go
all the
back home.
time.
and
We're
catch
going to
us.
keep up. This information is so fluid, but I really want to thank you guys. And Lisa, you're amplifying what the ground truth is in this supply chain, and it really is resonating with the people we do business with.
Well, we're trying to do that. And coast to coast, good morning as well. Gene Seroka with us here, Executive Director, Port of Los Angeles. Let's not forget Long Beach.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Michelle Meyer was definitive at the Bank of America and in analyzing the consumer. So much of the Bank of America credit card analysis she invented with her team. She was stolen. It's like, a trade with the Yankees and the Red Sox. Michelle Meyer at MasterCard Economics Institute is their chief economist as well. That's the curiosity here, is what does MasterCard see? What do you actually see in the behavior of American consumers?
So when you look at the trend in spending, consumers are still spending. And I think that the retail sales numbers show that pretty clearly as well. When you look through March and April, March was revised even higher. Pretty exceptional spending. And the fact that April was essentially flat shows that you didn't even see a payback after that. Like typically when you have outsized month over month gains, you see a payback thereafter. So looking through the last few months, certainly consumers are still out there spending. And I think they have the purchasing power to do it. And that's what we're seeing in our data as well. When we look at that pulse of the consumer in terms of expenditures, we see engagement.
Consumer spending, is that, when we think about retail sales, consumer spending, the folks that, where you are at MasterCard, is it really just about the job market? If I have a job, my spending habits are pretty consistent. Is that how it works? Or
I think that is the primary factor. It's, do I have a job today? Do I expect to have a job tomorrow? And what am I seeing in terms of my income flow to therefore accommodate or support my spending needs? Now, of course, there's going to be influenced by expectation. So how you feel about the future. Are you worried about the stability of your income? Are you worried about higher prices, which is obviously something consumers are worried about now? The wealth effect matters, particularly for higher income consumers. And the overall balance sheet matters too in terms of debt levels. But yes, I think you hit it exactly right, which is that it's a function of purchasing power, which is driven by the labor market.
you see a lot of the survey data, whether it's University of Michigan or others, and it indicates that the consumer is a little uncertain as tariffs and so on and all that kind of stuff. How does that? Do we see that in retail sales? I'm not sure we saw it necessarily today.
Well, look, consumers have a lot of reasons to be uncertain. The headlines have been scary and they've been changing rapidly. So if you're trying to plan for the future, I do think there's some concern right now, but you need what you need when you need it. And if you have the purchasing power to purchase it, you do. And that's what the data is showing.
I get hate mail. Lisa gets the love notes. Paul gets the love notes. I get the hate mail.
I can't imagine
and
that.
And the hate mail is, Tom, we're flat on our back. And this is what you're expert at. You invented this a few years ago. How concentrated is our buoyant consumer? Are we down to 10% of the country's driving consumption? Is it 20? Is it what's that number in your head?
Yeah. So yes, the upper income cohort drives spending disproportionately, of course, because they have the most amount of income and they have that wealth and they have the ability.
They have the confidence. People are, I look at the delinquency rates and all that. I know you don't want to talk about it. What percentage of America is doing our consumption. It's teens weens, right? Lisa, that's a technical phrase. Teens weens. How much is it?
So, yeah, I mean, if you look at the consumer expenditure survey from the Federal Reserve, it will give you a good indication. It's something along the lines of 40% of spending is driven by the top 20% of the income distribution. And they also have more consistent spending because they can smooth through shocks, right? You talked about the confidence. That is part of it. They have the ability to navigate economic cycles a lot easier because they have a cushion. But the incremental movement in spending is very much driven by not the upper income, but the lower income consumers. And we saw a lot of that during the post-pandemic period where spending largely exceeded expectations because you had very healthy labor market conditions, stimulus had flowed through, they had a low level of interest rates, deleveraging on household balance sheets, and lower income consumers were much, much more active.
What are the leading indicators that you look at for the consumer here?
So I would say I love the fact that the data is hitting right now because you have a combination of amazing data sets. But initial jobless claims, which are just out, I think are extremely important, right? Every Thursday morning, 8:30 Eastern, paying attention to see if jobless claims are moving from the trend. They're not.
Commercial free for this half hour with two important conversations. Michelle Meyer with us with MasterCard Economics Institute. Scheduled to be with us, Elizabeth Economy from Stanford and the Hoover Institution on the Pacific Rim as well. Okay, I have to ask because they ruined her weekend. I mean, Michelle was like, working from home 3 days a week, the whole thing, and MasterCard ruined your weekend. The tariff impact that MasterCard sees, what's it going to be?
My weekend was not ruined. I had a lovely weekend on baseball fields for my children. No, I think the headlines are obviously essential to follow, and we're doing a very close job doing that in the Economics Institute. But we're also really trying to be careful about swinging around our views and our forecasts at the Institute too rapidly, given how quickly the situation is evolving. So we're living in a world of scenarios, like I think many others are, and we're responding as we see the data change, if it changes. And frankly, the moment when you look again at consumer spending, you're not seeing significant shifts.
What's the key thing here for, MasterCard when you think about the economic outlook here? Is the risk of a recession less today than maybe it was 3-4 weeks ago? Has it changed that much? Or again, are we kind of trying to look through all that stuff?
So I think one of the differences in my seat now at the Economics Institute is that relative to my prior life on Wall Street and most recently at Bank of America is I think we have a lot more flexibility in terms of the forecasting process, right? In the sense that we have the ability now to look longer term. We're trying to guide our clients and our partners around the business cycle, right? Where are we going generally in the business cycle? What are the big themes? What are the big trends? Versus when I was in my prior role, it was more markets driven. So you had to have a view at that moment. Is there going to be a recession or not? And when is that going to be? And that's a difficult place to live in an environment that we're coming out of. So we've been very consistent and I think pretty calm relative to other economists in saying we're going to monitor the risks, we're going to adapt, we're going to adjust our forecasts and our views, and we'll talk about scenarios. But the modal forecast, frankly, it hasn't moved all that much.
Michelle Meyer, thank you so much. Great brief. Chief Economist, MasterCard Economics Institute. Can't say enough about her visceral feel for the American consumer.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
She's absolutely definitive on not only China, but this odd relationship of Beijing with Washington. Elizabeth Economy, Hargrove Senior Fellow, co-director of the U.S., China, and World Program at the Hoover Institution at Stanford University, and any series of books, including Books of the Summer for me and Books of the Year. We're thrilled that Dr. Economy could join us this morning. Liz, I'm not trying to be snarky, but what's next for China? I think they got a victory. We lowered tariffs. We lowered the import tax into America. What is next for Beijing?
I mean, so let me say, I know that the narrative has been that China won. I'm not sure there was any real winner in this. I think China demonstrated that, yes, it could go toe-to-toe with the United States, but both sides, reduced the tariffs. China had called for the United States to completely erase the tariffs before it even sat down at the table. I think people have forgotten that. And the administration didn't do that. They did come to the table with, a pretty concrete proposal on how to control the fentanyl precursor exports that has been so central to the Trump administration. And they took off all of the non-tariff punishments that they had put on the administration, things like the export controls on critical minerals and rare earths. So I want to level set a little bit, just because I think, let's understand the full sort of scope of this negotiation. In terms of where China goes next, I think what we've seen already is that China is going to move very aggressively to diversify their exports away from the United States. In part, there was a 20% drop in Chinese exports to the U.S. There was a 20% increase in Chinese exports to Southeast Asia over the past month or so. And even, I think, in the sort of low margin, factories, apparel, toys, et cetera, they're all talking about how to reduce their dependence on the U.S. market. So I think we've really introduced a pretty significant new factor into the Chinese thinking about the dependence of about the reliability of the United States. I think that's the big next thing for China.
So, Elizabeth, if you're China, are they looking to really kind of go it alone vis-a-vis the West? Or do they feel like it's in their best long-term interest to have a stronger relationship with the West, broadly defined?
No, I think they're definitely not looking to go it alone and move away from the West. I mean, they've made a big play over the past couple of months, because of the sort of overall chaos that the Trump administration has induced globally with these global tariffs. They've made a big play to try to assert themselves as the global stabilizing force. They've gone to Australia and said, please join hands. They've gone to Europe. I think they would love to revive the comprehensive agreement on investment that, sunk about 8 years ago now. They'd love to bring that back. I don't think the Europeans are interested, but the Chinese would like to do that. So I think, their strategy is to try to present themselves as a responsible and reliable trade and investment partner where the U.S. is not. And they'll do that, with the advanced market economies and with the global South.
Liz, we were talking, and this goes back, I can't, this is like when she was at Michigan as a freshman. This is 10 years ago. Elizabeth Economy here on China's rise in Southeast Asia. One of the themes we're addressing, Elizabeth Economy, is that China has other outros. It's not a bilateral outcome, or dare I say unilateral, for Mr. Trump, and that you can funnel China trade through Vietnam, through Malaysia, through other nations as well. Is that just a given for you?
I think certainly we know that, we've seen that. And frankly, in the Biden administration, we became aware of that when I served with Secretary Raimondo in the Commerce Department in sort of some of the critical technologies like advanced chips. That became a real problem because this was a good way to avoid the export controls. Actually, it was U.S. chips going through Southeast Asia and to China. So that corridor, which works both ways, can be problematic. And I do think that's something that the Trump administration negotiations with countries in Southeast Asia, with Mexico, with others, they're trying to plug that hole to prevent China from doing that sort of third-party shipping through to the U.S. to avoid any kind of restrictions or tariffs or other controls that the U.S. might be placing on Chinese products. So to their credit, I think the Trump administration is trying to manage that process.
Elizabeth, in the world of global technology, there appears to be, a Cold War that is developing between China and the West. A, do you agree with that? And B, how do you think that might play out going forward?
Yeah, I think it's important to recognize that China began the process of sort of technological decoupling around Made in China 2025 back in 2015. And we've talked about that before on this show, basically China's effort to ensure that its companies dominated in the manufacturing of components in 10 critical cutting edge areas of technology, like new materials and AI and EVs, and that then they became these global champions. So they started, by trying to close off their market in many areas so that Chinese companies would dominate. I think the U.S. has been more concerned about the strategic and security ramifications of some of these technologies. And so we saw, beginning with the first Trump administration through Biden and now Trump again, a dramatic increase in the use of our economic tools like export controls, in and outbound investment screening, trying to move supply chains, out of any sort of sole source dependency, but particularly in a country like China, where we feel that they're not a reliable partner, where they do use their economic leverage in coercive ways. So there's been, I think, this pull and this, away between China and the advanced market democracies. Whether that continues, I think, remains to be seen. I mean, President Trump, has sort of thrown a wrench in the plan. He talked about this massive reset in the U.S.-China relationship as a result of these talks, in Geneva. It's not clear what that means, but he did say, we are going to open our market to them. They're going to open their market to us. I don't know what he means by that, but one possibility would be to permit some of those companies, Chinese companies like CATL, which produce batteries, to actually manufacture in the U.S. So we may see some rethinking about that technology balance.
Liz, 30 seconds. Should we let China EVs into America?
I have to say this is an area where I think we need to protect our market, or we need to find a way to, I think, thoughtfully address the subsidies that China puts in not only EVs, all of those Made in China 2025 products. I think until we do that, the tariffs are probably a good move.
See how she goes British there? She goes right back to infant industry theory. Elizabeth Economy, thank you. Thank you so much. Out of Michigan and now at Stanford, the Hoover Institution. And I can't say enough about her books. I'll do something out on Twitter and LinkedIn and today with some of her brilliant books on Beijing and their politics.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
It's time for the newspapers. Got to get right to it. She had a choice of like 14 really crazy stories today. She whittled it down to 8. What do you got? Lisa, what do you have this morning?
Okay, I want to start with some tech news. This was a good one from Mark Gurman. He says Apple plans to add this eye scrolling feature to that nearly $3,500 Vision Pro headset. Okay, so I scroll. Okay, not eye roll that your teenagers give you. I scroll. Okay, like if you're looking on YouTube, it's when your eyes kind of move up and down and you can change the apps. Okay, so how it works, yes, you scroll through the software with your eyes on the Vision Pro headset. Okay, works across all their apps. What users are doing now is that they're scrolling with their eyes, but then they select by pinching their fingers. So now you don't need the fingers. Apparently, you'll just do the eyes. But it's in the works.
Is all this stuff remotely successful? Not only Apple, but Facebook and the others. I get the hope and dream of it. I don't want to be an old, fogey, boring. But
the future.
Are your kids using it? My kids have no interest in this stuff.
No, my kids have no interest in it. But they've tried the eye tracking feature before with the iPhone. I mean, it was for like people with disabilities and things like that. And other people have tried it. But they're just trying anything to get this Vision Pro. Like, they're throwing everything.
The Vision Pro starts at $3,499.
Yeah.
So there you go.
There you go. Enough said. Next.
They're trying to get some spark behind it. Okay, so what does it mean to be a reader? We're talking about eyes, right? Reading a book. So the Financial Times says that Gen Z could be changing the definition of what it means to be a reader because these are early teens to late 20s, just to give you an idea. A lot of reports show that they're not reading for pleasure, they're not doing this. But what Financial Times it says they are readers are just shifting in how they read. So for example, they like audiobooks, they like online reading communities, they like heading to YouTube, social media, following book influencers. So it's changing how reading is perceived.
I read books less, and I'm really upset about that. I used to be a good reader, not a very good reader, but I'm not. And I say this summer I'm going to be reading on the beach. But I said that last summer.
Is it because you're on your phone more? See?
Yes.
Okay.
Yeah. So I talked to Joe Weisenthal about this, and we're both actively reading at home. Just as almost as a symbol against. It's a protest, I would say.
Yep.
And I'm failing at home every day with the kids. It's like wicked serious.
Well, I look at that. University campuses. One of the marquee centerpieces of almost every campus is the library. Mm-hmm. My question is, what function does a library serve today?
I don't know. It's a huge issue.
I don't know. Yeah.
To me, this is beyond serious. What do you got next? That was terrible.
Sorry, I knew that would get under your skin. That's why I picked these. Come on. Okay, so if you haven't decided on your summer vacation yet, TripAdvisor has their annual summer travel index. So here you go. When it comes to top global summer travel destinations for Americans, number one is actually Cancun, Mexico.
Really?
If you want to be on the beach in Cancun, Mexico, apparently that's the number one hotspot. Okay. Paris, France, second. There you go, Tom. Third, London. So that's the order. Now, when you talk domestic, like here in the U.S., Las Vegas is actually
now we're talking
one.
The Bellagio, the Sweeney High Roller Suite.
Yes. Number two, hey, we don't have to go far. It's New York City. So there you go. Right. And then number three is Myrtle Beach. But they say they also want. Yes, I do too.
Yep.
And,
it is.
And we'll do it. We'll take the drive.
Yep. You can do everything there.
Yes. And you can. And it's beautiful. But what people are saying, too, is they want more experiences. So I don't know if when you go on vacation, if you do the whole excursion thing. And like they're saying more people want that rather than just sit on a beach.
I sit on a beach.
You sit on a beach.
The whole travel thing is turned upside down. And I noticed in the inflation report yesterday, airlines actually had a negative statistic.
Yeah.
It was down a little bit.
All the airlines kind of pull their guidance, lower their guidance.
Yeah. Newspapers, Lisa Mateo, thank you so much. Greatly appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.